Hi, how you doing? It's Bruce Whitey. I am doing this video because it's kind of rush. It is dated for now, although I can't tell you when it will really expire because it's a long-term situation that if you and I have been talking, we need to know some important data here. Keeping a little outline here of what I want to cover with you. This is kind of like breaking news. So why I'm doing this, interest rates are moving. I'm going to tell you more about that in a minute. The movement of interest rates matters a lot if you're working with me on most of the financial products and strategies that we do. Interest rates have a lot to do with outcomes. I also want to let you know that the Straight Talk Well show is going to launch again. We're filming 2 or 3 episodes later this week in our new studio. That's a much better way to talk about these issues. I'm going to go over the whole world of finance and economics. I'll tell you more by the end of this video. I have a place for you to also go to get some great further information. But again, this is rush. I just wanted to do this at my desk on Camtasia, which is my recording software, to get this to you. So look, I want to go over some recent news, and it's actually right up here on the screen, which is that interest rates may have topped out. Interest rates are falling. Now, what you need to understand is interest rates, high interest rates, are not good for people that are trying to borrow, but they're really important. They're so important to people that have saved and are saving and are trying to get a safe way to grow their money. This is a historically perfect. These are the best rates I have seen on insurance products, guaranteed income, guaranteed rates of just annual returns that I've seen in 20 years. Best I've seen in 20 years. We're topping out. If you've been thinking about it or you've been considering even what that world's like, this is the best time. However, it's changing, and that's why I'm in a rush, and that's why I'm a little bit like harried about getting you this data. One thing to understand is we have a potential recession going. I don't know. It could go either way. I'm going to cover a lot more of this when we do our show episodes on Straight Talk Wealth about potential recession coming, yes or no. There's 2 different stories to tell. I'm going to tell you both sides of the story. But the point is, many of you have been thinking about moving funds into safer places where you can achieve growth and a guaranteed income stream for life. So you've been thinking about that. Like, I don't know. You're looking at the same thing. The Fed's been raising interest rates, inflation. People don't have the money they used to have. Stock market seems to be happy and joyful as ever. Are we going to hit somewhere a change in this? And there is articles I'm going to explore here. Actually, let me just take a minute and just show you 1 or 2 headlines here. Let's talk about them just to know that I'm not making this up. Again, we'll do this more on the show, but here's one from The Economist. Recession in America by 2024 looks likely. This is saying it should be mild, but fear its consequences. And they're talking about the business cycle is turning. Okay, we'll cover these stories more in detail. Surging food and petrol prices, supply chain problems, war rage. So, okay, this is just, current events, but we're also talking about the business cycle. Is that going to happen? It's a risk. Here's one: mother of all economic crisis looms. Economist Nouriel Roubini warns. And he's just saying, warned about impending crisis in the global economy that policymakers likely won't be able to handle. He's got his reasons. Okay, I'm not here to beat this issue right now. Just want to mention. Here's one from Forbes. Recession forecast still right for late 23 or early 24, etc. There's a bunch of articles. Again, there's reasons to think this may happen. There's reasons not to. But I know so many of you have this on your mind. Okay, so this is what it has to do with interest rates. So, mind you, higher interest rates are a way to stop inflation. But what they do is they cause a slowdown in the economy, which means recession. And it's these 2 things the Fed's trying to do. So we have loved these high interest rates. They've been great for us and for our products. So here's the good news and the bad news to understand about all of this. Because the high interest rates are trying to slow the economy. We're trying to invest right now. The idea that they weren't going to go any higher stimulated the markets. So the markets are glad they're not going higher. But This is like just a continual game that's been going on. Anyway, so that's the situation that we have today. So here's the good news and the bad news. This is the best time ever to find safe places to put your money because interest rates are guaranteed and are growing money. The bad news is they may be falling soon, and some are already falling. So here, this article from Wall Street Journal says, Wall Street is gearing up for rate cuts. 20 months after the Federal Reserve began a historic campaign against inflation, investors now believe there's a much greater chance that the central bank will cut rates in just 4 months than raise them in the foreseeable future. There's now a 60% chance the Fed's going to lower rates by May, where earlier, back in October, it was 29% chance. So the same data has pointed to 4 cuts by the end of the year. Now, I saw this. I thought, God, how would I get this data? I got to start talking about this to my clients. Look, I already got the first email today, and I want to show you. I already got the first email from one of my major insurers, guys that were doing a really cool job on putting a product together. But tomorrow, the rate's down already. Now, it's going to go down a little bit, but if rates do come down because the economy does start to slow, we go into recession, these days of the best times for these products will be over. They will still be good products. They will still be worth investigating, but they won't be as good as they were today. And if I know if I talk to people individually and I try to tell them this on the phone or when I'm talking to them one-on-one, they feel like I'm pressuring them. So I'm just getting this out to you as general news. You decide what it has to do with your situation. I'm not trying to pressure any individual. I'm just trying to state the truth, which is I've been saying these are the best times. They're not going to be here forever. And here's the letter that I got. Now I've had to redact this because I can't put this all out as I can't. It's company material, so it's internal communication from them to me. So I can't put their company name. It's redacted. But I want you to see this because as soon as that article came out and I had a day to think about it, boom, it was already hitting my place and it was changing these products. So here's this company. I'm going to show you the product that it changed to and what these changes will mean. So basically all this is saying is on their fixed and fixed index annuities, rates are decreasing effective tomorrow, which probably means that if you didn't get it in today, you can't get these rates, but don't wait till they keep falling because we are still, and this is just one company. I've only got one company that's coming with this. The other ones have not. But typically when they're doing this, it goes really, really fast. So I'm not making this up about what has to occur. Now, I actually forgot to show you what product this was. And again, I wiped out the company name, but I just want you to see what's available right now because of the high interest rates that you can't get. This is a very simple 7-year account. It's liquid 10% a year. You can pull out, of course. The reason you're getting this is because it is a longer term account, but it's a great account for accumulation. I'll show you why. First of all, if you think the markets are going to go down on a fixed index product, remember that fixed index product will not go down when the market goes down. It will not lower. But if you're in a fixed interest strategy, when the market goes up, you're going to get some sort of share of that. And so you get the ups on the up years, but you don't get the downs on the down years. Now, if you think it's going to go down in a certain year, then nobody likes getting zero. So if you think the coming year is going to be down, right now on accounts over $100,000, they're just saying we'll give you 5.75% tax deferred. So it doesn't come out as a 1099 later like bank interest or CDs would. 5.75% for the year, and then you can shift it the next year. So first of all, that's a strong place to just go get guaranteed interest right now. That will go down tomorrow because somebody waited to step into this product or to understand it. They have another strategy here I love, which is just one of my favorites here. And this is the 1-year S&P. Oh, get that out of there. This is the 1-year S&P performance trigger. Very interesting strategy. I like this one because it takes a low performing market and bumps it up. So rather than getting a piece of the market, maybe not all of it, this one can actually multiply returns on a low performing market. This one says that on any given year, if the S&P 500 is 0 or above, they're just going to give accounts over 100,000 10.5%. If it's under 100,000, it's 8.8. So that means if the S&P 500 is 1% up, you're getting 10.5. If it's 3% up, you're getting 10.5. Any upward movement triggers a 10.5% plop into your account. And for the year, these are done on a 1 year point to point, which is another thing we can talk about sometime. But now, what's the downside of that? Well, if the market goes up 15%, you're getting 10.5. But if the market goes down, there is no downward way on this. It is the worst you can do is 0. And your risk is only not of you don't have the risk of losing money. You have the risk that you might make a little or you might make a lot. But in this particular strategy, if the markets perform poorly, you get a multiple of that up to 10.5%. That will go down tomorrow. We will probably see this at 9.5%, maybe this at 7.5%. I don't know how far down, but this again is where I'm talking about. You've got opportunity right now because of the high interest rate markets to survey these products, find the ones that are right for you, and lock these rates in while they're buying these high interest rates to fill them up with. Once the Fed drops interest rates, the banking system drops interest rates where they can't find the kind of bond portfolios they need to keep these afloat, they're going to drop rates on you. So all I'm really trying to tell you is that this is reality. This is an important thing. We're going to launch the show. And the other thing I want to say, if you'll give me just a couple more minutes here to explain, all of this is the push-pull of stagflation. And if you don't understand stagflation, then you don't understand the desperateness that I'm working with. Stagflation is where inflation rates are high, and you've got to have your money earning. It cannot earn because inflation of prices alone will eat it up. And the markets are going to be hammered because the Fed's trying to raise interest rates to slow down the economy, to stifle it. That means you're investing into a slowing economy. Now, right now in the last month, the stock market looks great because they think the Fed's topping out on this sort of suppress on the market. But we haven't had the results in the actual economy of that suppress yet. And we're going to look at this on future shows. But if you want to know more about stagflation and understand it, I want you to know that I did a 45-minute video for my clients on the topic, and I'm going to tell you where to go find that and watch it. If you want to take a little bit of time to understand the overall topic, it's a really good video. I'm very proud of it, very informative, not something I generally show the uninitiated public because it's a little bit technical, but I think I made it simple and easy to understand. If you want to know the topic more and strategies to win during stagflation, let me take you there. Okay, this is the landing page to go to, and it is Straight Talk Wealth, How to Win with Stagflation. And there's hyphens between each word. Straight Talk Wealth, How to Win with Stagflation. This is a 5-minute introductory video to tell you what is in the training. And if you want to do the training, you can register here and submit. And then it will take you to another page where you'll actually get to see the entire training video, which is right here. Okay? Strongly suggest share your thoughts when you're done looking at it. No cost, no obligation. Use this, if you will, to learn more about this. Otherwise, what I want you to understand is that these are the best times for some of the savers products, for people that are trying to be safe, trying to get growth. You have the most wind to your back right now at these times. They're not going to stay that way. As soon as the Fed thinks he's cooled down the economy enough, he's going to drop these rates, and they're the best I've seen in 20 years. Okay? Sorry to be so frantic, but these things matter to me. And the thing I get frantic about is how do I get this word out to all of you? How do I get everyone one-to-one to understand what's happening? So thanks for paying attention. And we will, by email, We will get the word out on the new Straight Talk Wealth radio. You can go to our website, straighttalkwealth.com. Pretty soon you will see the new episodes on the front. And hopefully we've made it clear how to sign up for a mailing list, email list. But just keep staying in touch. I just did this video today in the office because I had to. And talk again soon. Thanks, you guys.